Hello, and welcome to the Investing Iguana, the show where I help you make sense of the world of finance and investing. I'm Iggy, your host, and today we're going to talk about what's really wrong with China's economy. China is the world's second largest economy, and its growth has been a major driver of global prosperity for decades. But lately, China has been slowing down, and many experts predict that it will continue to do so in the coming years. What are the causes of this slowdown, and what are the implications for the rest of the world? That's what we're going to explore in this video. But before we dive in, please take a moment to like this video, share it with your friends, and subscribe to my channel if you haven't already. And don't forget to hit the bell icon to get notified whenever I upload a new video. Thank you for your support. Now, let's get started. China's economic slowdown is expected to continue, with GDP growth reaching just 4.5% in 2024 and falling to 3% by the end of the decade. This is due to a number of factors, including the legacy of the authorities' draconian zero-COVID policy, overinvestment in infrastructure, and high savings rates. One of the Chinese economy's distinguishing characteristics is its extraordinarily high investment and savings rates, which exceed 40% of GDP. This is double the level in the European Union and the US, and higher even than the rate in Asia's other high savings countries, such as Japan and South Korea. Investment has been integral to maintaining China's rapid GDP growth, but it is now generating diminishing returns. The construction sector is particularly overbuilt, with about 40 square meters, 430 square feet, of housing per person already existing. This severely limits investment's potential to drive further increases in income. Japan also faced a similar problem a few decades back. In the late 1980s, Japan's real estate bubble burst, leading to a severe economic downturn. The government attempted to stimulate the economy by investing heavily in infrastructure, but most of the new roads and other projects were not productive, and the government eventually gave up. China's high savings rates are also a problem. With investment declining, the excess savings will spill out into the rest of the world via current account surpluses. This could lead to protectionist policies from other countries, which would harm the global economy. Let me explain what this means. A current account surplus occurs when a country exports more than it imports. This means that it earns more foreign currency than it spends. This foreign currency can be used to buy foreign assets, such as stocks, bonds, or real estate. This is what China has been doing for years, accumulating a massive amount of foreign reserves. However, this also means that China is lending money to other countries rather than spending it on its own people. This creates an imbalance in the global economy, as some countries have more money than they need, while others have less. This can lead to trade wars, currency wars, or even financial crises. For example, some economists argue that China's current account surplus contributed to the global financial crisis of 2008 to 2009. By lending money to the US, China helped fuel a housing bubble that eventually burst. When the bubble popped, it triggered a chain reaction that affected banks and markets around the world. Another example is the trade war between China and the US that started in 2018. The US accused China of unfair trade practices, such as dumping cheap goods on the US market, stealing intellectual property, and manipulating its currency. The US imposed tariffs on billions of dollars worth of Chinese imports, and China retaliated with its own tariffs on US goods. The trade war hurt both economies and disrupted global supply chains. So, what can China do to address its economic challenges? It could reduce its investment in infrastructure, increase consumption, and channel savings into more productive investments, such as renewable energy. However, these changes will take time, and it is unclear whether the Chinese government is willing to make them. In the meantime, China's economic slowdown is likely to have a significant impact on the global economy. It could lead to slower growth, lower interest rates, and more protectionist policies. It is important for policymakers around the world to be aware of these risks and to work together to mitigate them. And that's it for today's video. I hope you learned something new about China's economy and how it affects you. If you did, Please give this video a thumbs up and leave a comment below. I'd love to hear your thoughts on this topic. If you found this video helpful, please hit that like button. It really helps us to understand what kind of content you want to see more of. And don't forget to subscribe. Here at the Investing Iguana, we're dedicated to helping you navigate your financial journey with confidence and clarity. And guess what? There's plenty more where this came from. Stay tuned for our upcoming videos, where we'll tackle other interesting financial topics like the best investment strategies, understanding the stock market, and how to make your money work harder for you. As always, we're thrilled to have you as part of our Investing Iguana community. Your support helps us keep producing free content like this. Remember, every like, share, and subscribe goes a long way. Thanks for joining us today. Keep investing, keep growing, and we'll see you in the next video. Bye for now.